Yeah, I think ultimately people are trying to get their money to work, and you put money to work to get a return. Very, very plain and simple. The other piece to be considerate of is for the non-stable asset holders, those who are sitting in, various Bitcoin derivatives or WBTC, Ethereum, and Solana. They obviously have a long view on the asset over time.
This content is brought to you by VeChain, which is a leading enterprise-grade Layer 1 public blockchain spearheading a digital revolution from a sustainable, highly scalable smart contract platform. The VeChain blockchain has many unique features, which makes it an ideal choice for Web3 applications. VeChain is working with many great enterprises such as PwC, Givenchy, BMW, and Walmart China. Most recently, they partnered with the Boston Consulting Group to build a revolutionary decentralized application ecosystem. I'm a big believer in this project. I have been since 2018. I've been a VET token holder for years. And this blockchain is highly scalable, great with security and speed, and it has low energy consumption. If you'd like to learn more about VeChain, please visit vchain.org. Link will be in the description.
Hey everybody, welcome into the Thinking Crypto podcast. I'm your host, Tony Edward, and joining me today is Nick Roberts Huntley, who is the co-founder and CEO of Blueprint Finance. Nick, great to have you on.
Hey, thanks so much for having me, man.
Nick, excited to speak with you and learn about all the great things that Blueprint Finance is doing and building on Ethereum and Solana and different protocols and much more. But let's kick it off with your background. Tell us about yourself and your professional background.
Yeah, sure thing. I guess a relatively strange background for most people in crypto these days. So I trained first and foremost as a physician in the UK. I was really fortunate to, I suppose, do a very human-facing job, a lot of human interaction, and now not so much in the world of anonymous individuals across chains. But trained first and foremost as a physician, loved what I did, kind of fell down the rabbit hole of doing computational drug discovery, ended up going back to school while I was practicing, studied evidence-based policy and economics at Oxford University before getting into software and building companies for a few years. Spent the last 7 or 8 years in the Bay Area working between Menlo Park and San Francisco. And, towards the tail end of that, spent a brief stint at Point72 working with the teams there. Loved my time as an investor, but kind of fell down the rabbit hole during the last bull run of kind of DeFi and markets more broadly. Going all in end of 2022, early 2023, when we started building Blueprint. Had been a crypto curious individual for a few years prior, having bought some Ethereum at $8 in 2017 and promptly selling it all at 30. So paid off some debts, but certainly poorer for it.
And that's an incredible journey, going from being a physician and then to finance and then to crypto. But that's amazing that you got into Ethereum around $8. That's an incredible price point as an entry.
Yeah, very lucky. I wish I could say it was by any kind of stroke of genius or intelligent design, but had, long time ago, I think I was still in med school, had asked wanted to buy a bunch of Bitcoin. I was using something called Britcoin, which was the UK exchange at the time, and my wallet was Bittylicious, which is a hilarious and kind of deprecated platform now. But had bought a little bit of Bitcoin back in 2011. Didn't really know what I was doing. Was just kind of dipping my toe in the pond. Tried to get my old man to buy a bunch and kind of laughed me out of the room. He was a TradFi guy and didn't quite come together. So had always been curious, and then kind of as I was falling down the general software rabbit hole and working with a lot of data and thinking about compute, ETH just piqued my interest, candidly. And so thought, why not scoop a little bit? And did so in 2017, which looked smarter than I promised it was.
And then you mentioned you spent time at Point72 and very familiar with Point72. Were you part of the maybe the process of setting up the digital asset side of that business, or was that after you?
Yeah, I actually wasn't. So that was happening on the other side of the shop. I worked with the Cohen Private Investments team. So very fortunate to work with a whole host of folk, laying a hand and getting to work alongside some of the fintech investors there, but also the enterprise software and deep tech guys there, which are some of the smartest guys around.
Very cool. And then how did the idea to start Blueprint come about? And essentially, you tell us what's the mission? What are you trying to achieve?
Yeah, I think one of the things I kind of obsess about are maturities of markets. And, if you look back to 2021, 2020, markets were really thin. The idea of putting 8 figures, 9 figures, even some desks now sitting with a couple $1 billion of assets to work was really, really hard. And of course, we're seeing net new market structures in the forms of ETFs and other institutional products coming to market that enable some of these deeper flows in a more controlled fashion. But realistically, like, life on chain was thin. People were pushing markets around, and that was really interesting to examine from just a forensics point of view on chain. But what I realized was the speed with which people were able to build new protocols vastly accelerated beyond the capabilities of retail and consumers to get the value out of it. So we started to narrow where the value was being accrued. And so when we started the company, the basic premise was, how do we get people the best experience in DeFi without forcing them to become a PhD level on-chain participant?
Right.
Liquidation mechanisms are harsh. I think that yield can be really complicated and challenging to extract. And so we wanted to build kind of the rails to make sure that people could get the best rate of return on their assets without having to think or do too much, raise debt in a very simple and controlled fashion, and ultimately protect themselves from really harsh liquidation mechanisms, which is why we have kind of earn, borrow, and protect as the 3 legs of our product stool for Concrete, our EVM compatible protocol.
And then I read that there are 2 items that you're primarily working on: Concrete, which is a DeFi aggregator. If I'm not mistaken, that is on Ethereum, and then the other is Glow Finance, which is a liquidity hub for Solana. So tell us a bit about those.
Yeah, so Concrete's kind of our initial flagship protocol that we started building in 2023. We effectively have a series of vault structures where you can deposit your assets, receive a vault share token. That vault share can then be used in our money market, which we're going to be launching soon enough, in order to raise debt. And then from there, you can also do a kind of cool feature, which we're launching, which is to buy kind of a credit facility. Think about it as if your loan's in trouble and you need protection and you don't have the liquidity to deposit to make sure you don't get liquidated. We have an automated facility that'll top you up to keep you from losing your assets should there be something like mean reversion that occurs after the price dips and comes back, which we've all been through so much in crypto. And that's kind of the structure of that right now, working with some wonderful partners in the form of asset issuers like Lombard, Athena, and ramping up a few other large deals in the process. And then network operators like Berachain, as well as Quorn, kind of some of the places we've been putting money to work for the last kind of better part of 5 or 6 months. It's been a really exciting time. On the Solana side with Glow, kind of interesting story. You may be familiar with a protocol called Jet Protocol. Jet, I think, was probably one of the best products to come to Solana in the history of Solana's kind of life cycle in DeFi. For a number of various reasons, didn't quite find the purchase within the market that I think it deserved, particularly from a technical standpoint. Perhaps that was to do with user interface or user experience or kind of articulation of the product. I don't know. Something happened early part of last year, which afforded us the capabilities and opportunity to acquire Jet Protocol. And so for me, I've always thought about, again, trying to build this trusted environment for people to get the best rates of return on their assets, wherever that might be. And I think the Solana DeFi ecosystem is so interesting and so specific that had always had grand or, long-term plans and visions to be part of that with a product, and the opportunity to acquire Jet Protocol were just something that made so much sense for us as a company. And so we launched that with an LRT a little over a month ago. And so we've got some big announcements and some big launch plans for new features over the coming months there as well.
That's exciting. And are these services for retail and institutional, or just one sector?
Yeah, we have a retail kind of product. Anybody can enter in, which is not stage gated or anything like that. There's no requirement for minimum assets. There's no requirement for KYB or anything with KYC. It's very much an open platform. We just partner with a handful of institutional desks who want to distribute funds specifically. And I think a lot of crypto, while it is decentralized and it is, in a large part anonymous, there are a lot of human relationships that you get to build through going to conferences, getting to know different asset issuers, network operators that try and enrich the ecosystems. And so build great relationships with some of the institutional desks looking to use us as kind of infrastructural rails in getting their assets to work.
And For the institutions, what type of institutions are you encountering? I don't know if you can name drop, but are they like hedge funds and family offices, things like that?
Yeah, I think institution is such an interesting word in crypto. Um, when we think about that in traditional finance, you think of the Point 72s, the Millenniums, the Citadels of this world.
Mm.
And then when you come to crypto, actually, it could just be an individual who's been a significant participant in the ecosystem and is managing 50 to $100 million of their own personal capital.
Sure.
And does that qualify as what we would consider institutional grade in traditional finance? Maybe not, but it is just the market that we play within. So, there are really sophisticated partners that we're fortunate enough to work with. We recently announced a partnership between ourselves, Lombard, and Centaura, where we're running a pretty impressive system there with them to get really high rate of return on LBTC going to work in the market. There are a handful of other kind of curators and strategists that we're planning to roll out a few things with over the coming weeks and months. But those are what I would call like the on-chain execution side of things. The other parts and partners that we get to spend a lot of time with are kind of the more institutionalized family offices with significant digital asset exposure, wondering where and how to get their assets to work. And we don't formally work with what I would say any big institutional funds, particularly here in the US, of course, for regulatory reasons. We're fully compliant. But I think the candid answer is there's a huge amount of liquidity out there, typically sitting within sophisticated, well-educated family offices looking to get to work. And we certainly work with a number of them to facilitate that flow.
Now, for the people listening and going to be watching this as well, walk us through what these institutions and folks are looking for. Is it yield? They're trying to get instead of having the asset just sit there, they're looking to lend it out or earn, maybe put it into stable coins and earn some sort of yield?
Yeah, I think ultimately people are trying to get their money to work, and you put money to work to get a return. Very, very plain and simple. The other piece to be considerate of is for the non-stable asset holders, those who are sitting in, various Bitcoin derivatives or WBTC, Ethereum, and Solana. They obviously have a long view on the asset over time.
Sure.
And so what they're really looking for is a trusted partner to think about where is the best rate of return for that, in keeping with the amount of size they have to get to work. Again, I mentioned kind of earlier in this conversation, it's quite hard to put 500 million or $1 billion to work in crypto because markets are kind of thin, particularly in a single asset. Yeah. So how do you break that up? How do you distribute it in an egalitarian fashion that gets you the best risk-adjusted rate of return? Obviously, the further out on the risk curve you go, the higher the potential, often the higher the potential ceiling of rate of return. But when you're dealing with slightly more institutional, long view investors, it's a case of finding that kind of Goldilocks position to make sure they get the best rate that they possibly can without absorbing too much risk.
And then the assets, when that is put into the system, so to speak, is it all locked in smart contracts or is it sent to a custodian? Walk us through that process.
Yeah, a little bit of a hybrid system with us. We are onboarded with all the major custodial solutions, and we have great relationship with them. Very excited for some of the interplays we have between Concrete coming up with some of the centralized exchanges, which is, I think, a really interesting way. We've seen, obviously, the birth of a lot of CDFI hybrids, and we think that's going to be a big part of our story over the next year or two. The other piece is that we do have what I would consider very traditional crypto native DeFi handled funds and strategies where everything is handled through our smart contract infrastructure and across various networks.
Got it. Are there plans to go beyond ETH and Solana to other chains?
Absolutely. Yeah, I think we've kind of found this interesting rhythm here where a lot of funds sit on ETH mainnet. That's obviously where the broad amount of depth for the EVM ecosystem sits. And a lot of the institutional grade and family office and high net worth individuals who are putting funds to work like to live in ETH mainnet and then kind of roam beyond there to try and find a new and increasingly interesting rate of return, whether that be a new network, a new L1, a new L2, bridging those funds back and forth. And a lot of the kind of service that Concrete can provide is the handling of those funds. So receiving funds on ETH mainnet, distributing them to another chain, and then receiving them back to ETH mainnet and handing those rewards and that rate of return back to the depositors. And that's kind of the beauty of the architecture and the infrastructure that we've built, that in theory, you can get yield from anywhere at any time, but only ever have to interact with the ETH mainnet instance of Concrete.
And then as far as supported assets, is it kind of the top liquid assets like your Bitcoin, ETH, Solana, maybe XRP and things like that? Or do you go further down the list as well?
I like to think about us as network agnostic. So we want to be everywhere at all times to get the best rate of return and make sure that those yields are available to all of our depositors, but pretty asset constrained. So we do really only work and handle a small group of net new asset issuers, and then kind of your traditional minted blue chips, your ETH, WBTC, USDC, USDT, etc. And then we do focus a lot on working with the network operators on their network tokens. So great relationship with the Berachain team, and so working on some interesting ways to deploy the Bera token and get a high rate of return on that within the Berachain ecosystem, of course.
Now, a big question a lot of folks are going to have, because the history of DeFi 1.0, if you want to call it that, there have been exploits and security problems. So walk us through a bit of your security setup and what guardrails you have in place. What steps are you taking to avoid things that we've seen in the past?
Yeah, I mean, with the 24/7 market, it's the one thing that keeps all of us up at night and up early in the morning again. We've been pretty rigorous from day one. And so we've been fortunate to work with a handful of kind of top tier auditors, as well as doing some more public kind of DeFi bug bounty programs. So, a big shout out to Halborn, who've been on retainer with us for a long period of time. We have multiple audit lines with them. So pretty much every line of code that we put up from a smart contract perspective has been through the hands of multiple auditors at Halborn. We use Code Arena. We use a really cool emerging company called Test Machine, which should, kind of name drop them. They've been fantastic, some really smart guys building some AI-enabled testing facilities and security enablement for us. So thank you to them. And then, also working with groups like Satora, and we did an initial full system review from TrailerBits as well. I think you can't be shy about getting involved and being engaged on the security side of things. It's a critical component, because once those funds are gone, they're gone, and someone's going to plug the hole, or you're going to be in a spot of bother.
And you mentioned you kind of have a hybrid model because you're using qualified custodians as well to store some of the funds.
Mm-hmm. Yeah. I think the interesting piece here is that, particularly for some of the institutional partners that we work with, they have a strong predilection or preference for working with particular custodians. And so in order for us to be kind of a full service or fully functional shop for what they require, it's important for us to think about preferred custodial relationships, particularly some of those funds being under specific mandates to only be handled by certain custodians as well.
Now, we're seeing crypto legislation is on the cusp of being passed. Congress is working on these things. We're going to have clarity. Certain restrictions have been rolled back for banks, like SAB 121, and FDIC has loosened restrictions. So a lot of these banks and Wall Streeters are going to be able to come in and participate. Are you looking to work with those folks? And are you pitching them, hey, you can use our DeFi protocols, et cetera, et cetera?
Yeah, I mean, I think the long story short there is we're in a really, really interesting period of time where I think we'll see what I call deregulation through regulation. I think the first memo I ever wrote for a justification of starting Concrete particularly was a reference back to 1982, which is super obscure. But there was something called the Garn-Saint-Germain Depository Institutions Act, which was a period of time whereby the economy was looking for interesting assets and needed interesting assets to stimulate some kind of market rejuvenation after a period of compressive yields. And that was a really interesting period of time that allowed a lot of derivative products and what were previously risky, perceived risky investment opportunities to be deployed into using some consumer funds, and that was largely done by banks. To me, I see a really interesting pattern emerging that we're coming out of a complicated economic market. We have a lot of different market forces, both domestic and overseas, pushing the markets around. And I see that digital assets could be a really significant bastion for how we diversify yield opportunities for institutional desks across the US particularly. So, are we actively in discussions with any of those major institutions? The answer is no. I think we won't necessarily entertain that until there is regulatory clarity. But I am extraordinarily bullish on the fact that something like deregulation through regulation over the next few years is likely to happen for digital assets. And of course, there is a mountain of capital looking for places to get the right rate of return. And if we can facilitate some of those flows in obviously a fully compliant way, we'll absolutely, take up the call.
Yeah, and, along the lines of what you're saying, it seems like this is the next big macro trade. To your point of looking for yield, looking for a better return, because not saying other asset classes are not giving a return, but this is giving a bigger return, given that maybe it's a truly global asset class. Many of these coins are hard caps, so you have a supply and demand economics that we've never seen before. Bitcoin only 21 million, some is lost already. Throw in whatever other blockchain and tokens. Do you see it that way as well?
Yeah, I think certainly the open access to these assets is a huge, huge kind of market barrier that has been broken down. I think the global participation is massive. Obviously, we're seeing pretty significant geographical disparity between the average number of individuals within certain countries that both hold digital assets or have a wallet or have a non-custodial solution. I think, the UAE currently pretty significantly above a lot of other states in having the average person within the country hold digital assets and be actively involved with essentially a centralized exchange. And of course, out in Asia, we see a huge amassing of capital over a long period of time, given some of the mining activity that's gone on out there and continues to go on. So I think we'll have to see a bit more of a equal distribution of per capita holdings of these digital assets, or we start to see the institutions themselves hold them as a representation for their customers and their consumers or depositors, whether those be banks or other investment vehicles. Be a great way for us to get some more distributed exposure to that within new markets and new states.
And it just seems like that is a direction where a lot of these big banks will probably be offering crypto trading, the ability for you to buy through them, of course, and they'll custody for you, especially, as mentioned earlier, SOB 121 being removed and crypto legislation coming into place. It seems like they have the setup to just call the average Joe and Jane and say, you want exposure to Bitcoin, ETH, Solana, whatever it is, and we'll custody it for you, and then possibly open up DeFi opportunities for these folks and to earn passive income or yield.
Yeah, no, absolutely. I think that's the most probable way we'll get broad distribution of digital assets across general population, if you will, those who maybe aren't spinning up a non-custodial wallet and interacting with smart contracts directly. For us as a company, what we really think about is when we get that regulatory clarity of how to operate in the most compliant fashion, how do we fill the space? I think there's a learning curve in crypto that most of us who are in the space have had to go through. And many of us have been either liquidated or lost funds or lost keys and had all those rather nasty experiences over the last few years. But, we've kind of all got our bruises and battle scars from doing everything on chain together. There is an interesting learning curve that I think the institutions themselves are going to go through in terms of how do we interface and interact with the asset issuers, with the networks? How do we get this debt to work? They're obviously working at it tirelessly at the moment. And some of the most sophisticated participants I've come across in the last couple of years have been out of those large institutional firms trying to understand better how to best incorporate that within their investment thesis. For us, it's obviously a potentially massive opportunity to sit between institutional desks and kind of the on-chain infrastructure and the on-chain activity and be the kind of conduit as such for those flow of funds and those rewards to go back to consumers. And we'd relish the opportunity if it does present itself.
Looking at the macro and the outlook of the adoption of the technology, we're just talking about the banks and these institutions being kind of the on-ramps for a lot of people, right, in the general population. But the future generation, my daughter, let's say, who's 7 years old, she's going to be in a much more digital world than we live in. Things are only going to get more digital, where people are not necessarily going to use paper money anymore. It's all going to be digital IDs and so forth. That the future generation are going to be much more educated. They're not necessarily going to be I don't know, intimidated by a seed phrase setup or wallet address. And by that time, the infrastructure, the GUI interface will be a lot easier for them to navigate. That they may not even go through the banks as on-ramps, but kind of be sovereign in a sense and hold those assets and do the DeFi through their own setup. Do you see it going that way as far as the adoption?
I think that's certainly the Maxi's view of things. Can we take apart traditional established financial rails, guards, and systems and replace them with an entirely sovereign system? Personally, I don't think that'll happen.
Hmm.
I think that with the right regulatory frameworks, we can benefit from the operational efficiencies that we get from on-chain behaviors and digital assets that perhaps a slightly more antiquated institutional set of financial systems, rails, currencies, exchange functionalities, transfers start to get taken away. I mean, it is kind of ludicrous when you think about the fact that at any point in time, at any day, I can transfer capital between one place to another and it be almost instantly available. But if I was to go to my bank Friday, 5 p.m., I'm in trouble, which is with the kind of pressure and expectation for us to all be on at all times, regardless of whether you work in digital assets or not. You know, whether you're working at a bank or whether you're working at a consulting firm or whether you're working in traditional CPG goods or, you know, sales and services, everybody's, you know, businesses are still open on Saturday and Sunday, you know, and we can't afford ourselves the financial tooling and access and speed that we do within crypto and digital assets. That's got to change. So I do see some really interesting ways in which over time we'll probably see people and institutions adopt slightly more friendly and sensible ways in which we can move funds, particularly to keep kind of markets open 24/7 in a certain kind of way, or at least flow of funds and access to funds for people. There will be an emergent class of younger generations that are fully digitally native and I think fully, quote unquote, sovereign or strive to be fully sovereign from a financial perspective. We've come across a few engineers that we've worked with over time that I don't think have a bank account. And only live on chain, and a couple of them live in slightly obscure and remote locations, and that's how they choose to live their lives. And they've really decided that's a way of life. But I don't think we'll see kind of the tear down of traditional financial institutions and full disruption. I think we'll see kind of a hybrid model over the next decade.
Yeah, that absolutely makes sense. And you see many of them now are looking to tokenize traditional assets, whether it be stocks and commodities, real estate, on the blockchain and trying to, compete. And on that note, with tokenization of traditional assets, do you see that being pushed into the arena of DeFi where maybe I can do more with my Tesla stock than have it just sit in Robinhood? If it's tokenized, I can do some sort of DeFi lending and much more.
Yeah, I mean, in any market, whatever it might be, whether it's in traditional markets or whether it's in DeFi or whether it's just crypto more broadly, there's always some premium that someone's willing to pay for access to an asset, and whether that be holding it, custodying it, lending it out, borrowing against it, whatever that might be, there is some cost of capital. And realistically, what we're saying is here is a new form of creating a representation of another asset that has value, who is willing to pay a certain rate for access and utility of that asset. I think we've gone through relatively interesting period during the last bear market of, obviously all the meme coin kind of nonsense that went on and a lot of activity there, creating assets that don't have any intrinsic value. I think kind of the RWA push that we're seeing right now is a great argument for why we want to see assets being represented on chain that have intrinsic value.
Yeah,
that is a very, very healthy direction. But we also need to start thinking, in our opinion, of how do you create natively digital assets that have intrinsic value based on the behaviors and the actions they take on chain. And again, head towards a sort of hybrid system where perhaps a rate of return or an opportunity from a real world asset might be a little compressed comparatively to the risk curve of natively digital assets. But in conjunction with more on-chain activity with the conjunction of slightly more risky digital assets, you can create a well risk-adjusted distribution of returns, which gets you more than what you might get in a traditional finance environment, but less than what you might have to take on in terms of risk from being fully natively on-chain. And so again, coming back to my comment on where does finance go over the next decade, I think similarly to in a slightly more micro or meso cycle for now, we'll find a sweet spot where it's RWAs plus what I would call slightly riskier digitally native assets coming into conjunction to best build the best risk-adjusted portfolio.
And, given that outlook that you just mentioned, right, and the hybrid model, let me make sure I phrase this correctly or articulate it well. We had like Web 1.0, 2.0, we're in Web 3. Where are we for DeFi? Are we in 1.0 or 2.0 in your opinion?
We're certainly not in 1.0. I think, there are some tentpole companies that were built a few years ago, the Uniswaps of this world, the Aves of this world. I think even GMX was like a great example of, a fundamentally like interesting way in which we design businesses. We're starting to see new kind of flagship enterprises getting built, like what Guy's building with Athena, I think is a really world-class example of a great business with real utility. I would like to say we're somewhere in between 2 and 3 for DeFi. Obviously, there was a lot of challenges in the last bear market for DeFi. It was kind of a dirty word for a while. And that was when we were building. It seemed contrarian for us to be out building something that was so focused on being infrastructure for a market that, according to a lot of people, was dead and done. But I think in any system where you're looking to have speculative value, intrinsic value, trading activity, it makes perfect sense that DeFi needs to exist. I would argue that perhaps it's a little behind where it needs to be, but hopefully with the amount of activity and interest, and particularly obviously asset performances recently, we can start to see a bit of invigoration, and institutional adoption is certainly pushing people to build better products. So I would say we are maybe somewhere between 2 and 2.5, headed towards 3.
One of the things I've been thinking about lately is, there's a law of diminishing returns. Like you're not going to get the same return. I'm invested in crypto, obviously, Bitcoins, ETH, and so forth. And of course, as the cycle is continue and there's more liquidity, you get the BlackRocks and all these guys coming at the banks. You're gonna not have the same upside. But if I'm holding some of these assets long term, I need to generate some sort of yield, get put it to work, as you mentioned earlier. And I see like DeFi becoming even more important than ever to do that, right? I don't know if you agree with that.
Yeah. So do I think if Bitcoin traded at around $16,500 a few years ago, we're going to see the same base multiple on the raw asset price over the next 3 or 4 years again, and see Bitcoin trade up to $500,000? Probably not. And so your question is completely valid. How do I now, having owned an asset which has appreciated, put that to work and create value from it? And I think if we are seeing the emergence of a net new investment asset class, the critical component now is how do we create consistent, meaningful rates of return on it and provide the right infrastructural tools and financial products around it? It's kind of like, how do we get mortgages to become valuable? How do we create these new fundamental tools and products for institutional desks to move, price, trade, restructure? That's a really, really interesting curve for us to get onto over the next few years. And I think this big push of real world assets getting tokenized is kind of the first foray into that. It's kind of like, okay, great. We've created a realistic representation of an asset with intrinsic value. What are the mechanisms and tools we're afforded on chain that we aren't necessarily afforded in traditional finance to create value from that? And then similarly so, are there people who hold very, very entrenched or historical views on traditional assets, real world assets, if you will? And then how do you give them exposure to an asset class that they're not typically bought into? Now, how do we get somebody who's a big real estate investor to take on some Bitcoin exposure or some ETH exposure or some Solana exposure? I think those kind of interplays are going to be where we'll see real activity over the next couple of years.
I'm really curious. You mentioned the housing market and real estate. The bridge, I know some companies are trying to do this, but I haven't seen anything fully fleshed out yet. But the bridge between crypto and real estate, being able to use like your Bitcoin as collateral to buy a house, things like that. I'm waiting to see when that happens. And I don't know if DeFi may have to be a part of that.
Yeah, I mean, hopefully no one's paying 10,000 Bitcoin for a pizza these days. But yeah, I think that it's going to happen inevitably. You see certain stores and merchants taking Bitcoin as payment for cars and watches, clothes, and slightly more retail-y products. It's going to happen. Somebody is going to be willing to underwrite that asset as qualified tender and a comparable trade. That's all it's going to have to come down to, and that comes a little bit from being able to hedge risk. It comes a little bit from just being able to have the facilities to get in and out of that asset very effectively with minimal costs. And it comes again from being able to have a little bit of the historical performance of those assets, as well as starting to be able to build the actuarial models around it. Now, actuarial science is something that's taken near a century to get to where it is right now. That's because it has had decades and decades and decades of behavioral economics baked into it, as well as pricing mechanisms. We just don't have that yet with digital assets. And the depth of the markets, having grown so much in the last few years, fundamentally changes the dynamics of how those assets can be priced, as well as how they flow. So we're learning as we're going. It's the beauty of still being early. We are still early, I think, and lots to come, I think, on the pricing structure and just being able to build trust for people who don't typically trade in these types of investable assets to get comfortable with accepting them on their balance sheet. And of course, again, going back, there's a lot of regulatory frameworks that need to come into play.
Oh, for sure. Yeah, great points. What's on your roadmap for this year that you can share?
Yeah, look, I mean, it's been a busy start to the year, and we've grown really, really quickly. I think there are two things we want to do. We've just made some fantastic senior hires at the company, which we'll be announcing soon, to kind of bolster and make ourselves ready to scale over the coming months. We are launching our money market for Concrete in the next kind of few weeks or so. And then on the back of that, we'll be deploying our kind of protection facility, which is to help people from getting liquidated shortly thereafter. We do have a new asset issuance plan for our own platform coming out towards the end of the summer, which I probably can't talk too much about, but please watch this space. We're excited to bring that to market and give people some real utility on top of what we're serving out of Concrete. On the Glow side, I think we launched that a month ago. We've kind of just been tinkering and testing and making sure that it's super durable. And we'll be launching a handful of net new recipes and trading opportunities there. The team there has been unbelievably performant and kind of cranking out everything that we've needed to in very short order and extraordinarily high quality. So that's going to be really fun to see us scale what we have on the Solana ecosystem side for, both bringing new assets to the ecosystem with some stable coins and some other kind of LST and LRT derivatives from some of the biggest asset issuers in the market, as well as getting those things to work and getting what we think is a really interesting rate of return without taking on too much risk.
Good stuff. Well, we'll definitely have to have you back on as those things come to fruition. So really great stuff.
Anytime, man.
Yeah. I know we're coming up on time, so I wanted to get your perspective. We kind of touched on it, as far as your outlook on crypto in the United States, obviously completely different environment, Congress working on legislation. A lot of folks seem to be coming back to the United States. Do you see once legislation's in place, we see a kind of a economic boom, if you want to call it that, around crypto and the industry?
I'd like to think so. Obviously I am heavily invested in the market and have a lot of personal exposure to it. Crazy to say that this administration is obviously not looking at the asset class more broadly in a much more favorable manner than the last administration. I think we're still figuring out what that looks like and what those policies are going to afford us the ability to do or not do within the confines of the US regulatory frameworks. Personally, not that I'm placing any monumental position on this on Polymarket, but I think 2026 will be a huge year for the industry. I think we'll spend the better part of the next 4 or 5 months figuring out what it is we truly can and can't do and what is the best way to approach the market within the US. And then I think kind of coming into the end of the year and going into 2026 could be really exciting times for the industry more broadly. I think we've still got a few hurdles to get over and a few speed bumps to get through before we get to that point where we could really say it's up only for a while.
No, for sure. All right, I got some wrap-up questions here for you. First, if
Sure.
you could create your own metaverse, what would the theme be?
So that is a great question. Honestly, I'm originally, my family's from South Africa, and I love being out in the wilderness and in the bush. So I just make a giant safari or game reserve and just hang out there.
Nice. Rapid fire questions. Favorite food?
Oh, Bob's Donuts in San Francisco, world class.
I gotta try those when next time I'm out there. Uh, Favorite musician or band?
I'll pick a favorite song. I'm like very transient. So right now it is Julia Wolf and Badger in My Room remix, pretty much on repeat a few times a week.
Nice. Favorite movie?
Lord of the Rings.
Favorite book? Maybe
Lord of the Rings.
Yeah.
Very, very straightforward from my side.
And when you're not working at Blueprint, what are you doing for fun?
Unfortunately, with 24/7 markets, you don't get too much time to rest, but just trying to keep myself fit and healthy so I can keep up with everybody.
Awesome. Nick, absolute pleasure. Love what you guys are doing. And like I said, I would love to have you back on as things progress, but thank you so much for joining me.
Anytime, man. Thanks so much for having me.